Please remember, nothing in this show should be taken as financial advice. Note that I have a bias towards the XX network because I am affiliated with them. Half the world is composed of people who have something to say and can't, and the other half who have nothing to say and keep on saying it.
This is a foundation of trust upon which everything is built. Yet, far too often, we take it for granted. It's often just viewed as boring economic plumbing. Maybe that's why we often assume that the safest approach to managing risk involves following the paths cut by others years earlier. This strategy seems to have worked for Canada, with any resulting inefficiencies or limitations in global competitiveness being cushioned thanks to our abundance of natural resources. I fear, however, that the digital era won't be so forgiving. I fear that we can no longer take our prosperity for granted. We need to embrace the digital era in a meaningful way. And I imagine a government that is focused on maximizing opportunity rather than just minimizing risk. How might this cause Canada's competition laws, privacy laws, payments modernization, banking, and digitalization of government services to differ from how they are today? What if Canada had a horizontal approach to policy development and implementation that cut across our countless silos and actually equipped us for the economy of today and tomorrow?
Colin Deacon is the Senator of Canada for Nova Scotia. He's a member of the World Bank and the IMF.
As we accelerate into the digital era, we will have to prepare for a multitude of new risks and new opportunities. This is good news because we are starting to make some progress on payments and open banking. Why is this important? Well, in terms of payments, in 2021, Canadians made roughly 20 billion individual transactions, totaling nearly 10 trillion in value. However, our interchange fees are about sixfold those of Europe. When you're dealing in trillions, a day here and a day there, and a fraction of percent here or a fraction of percent there, ultimately adds up to a whole lot of financial friction and cost across the economy, and a considerable amount of profit for a few. As it relates to open banking, how we assess credit risk and how we create the conditions for financial success, especially in communities that are marginalized, is central to maximizing the potential that rests inside every Canadian and to minimizing dependence on social supports. Our traditional banking system works well for much of the population. However, for far too many Canadians and small businesses, it is expensive, slow, inflexible, and represents a barrier to their success. Our big bank CEOs and their economists all call for increased competition across our economy to spur investment and innovation and the resulting productivity growth. But when it comes to increased competition in the banking sector, change there, it seems, is not so welcome. However, the potential to improve is everywhere. Embracing new technologies like blockchain can make services, both private and public, more efficient. In Australia, a Canadian company was contracted to implement a blockchain project to manage the collection of excise tax on liquor. And it created an estimated $600 million in administrative and payment efficiencies for the Treasury and for business. This is just the beginning.
Colin is part of the Banking Committee. He's talking about transforming the banking system to open banking, which means allowing third parties to interoperate with the banking system and data through API. This will open the door for crypto companies and blockchain-based technologies to improve efficiencies. He's talking about the incumbent's role and how by providing a level playing field with financial plumbing, there will be more competition. This is exactly what David Schwartz as well as others have talked about. In order for cross-border payments to become efficient domestically, the payment systems need to be modernized.
However, I worry that until there's a crisis, we Canadians are often far too complacent, as are our legislators. I worry that until there's a crisis, we Canadians are often far too complacent.
As central banks are battling inflation, they raise interest rates, and this puts a tremendous amount of stress on the correspondent banking system, leaving higher fees and frictions. When there is plenty of liquidity, the system runs smooth. Today, that liquidity has been removed and the cost of borrowing has surged.
Worst performing sector right now. A lot of pain there, especially in the regionals and especially tied to the West Coast banks. Crypto bank Silvergate shutting down, announcing it will wind down operations and liquidate in the wake of industry and regulatory headwinds. CNBC reporter Tanea Makil joins us now. She covers crypto for us. So, Tanea, it's good to have you. Explain how Silvergate became the latest victim of the crypto collapse and what the spillover effects are.
Last month, I wrote an article for the Lighthouse Report about Silvergate. Well, it looks like it's coming to fruition. Silvergate has started to liquidate their assets. Today, banks across the board have taken significant losses. Credit Suisse failed to hand over their report to the SEC. JP Morgan was down 8% or higher. Silicon Valley Bank also dropped 60%. Something is wrong with the banking sector, and it's starting to surface.
Well, look, tail risks have been and remain elevated. And there's a warning today with the incident at Silicon Valley that the biggest risks are outside of the largest banks. The largest banks have been regulated and over again. You have an annual Fed stress test that I estimate is the equivalent of the last 3 recessions combined. So the key word here for the largest banks is resiliency. Resiliency of the balance sheet, resiliency of the business model, and resiliency of funding, even if that resiliency isn't quite as strong as I thought with interest rates at 3%. Interest rates at 5%, you know what, the title of our note today was, you know, bank stocks have gotten palled. Okay, the Fed going up so much. So warning number one is beware of financial firms outside of the largest banks. And warning number two, this economy is a little bit like a souffle. You get your ingredients, you cook it, and then you put it in the oven. But if you look at it or open the oven too often, it can collapse. So going from 0 to 5% interest rates in a period that's faster than any time in 4 decades, you're going to have casualties, but it's more likely than not to be outside of the largest banks. The largest banks are a pillar of strength and stability here. Everyone's getting painted with the same brush. It looks a little sloppy. This is the sort of time, I'm not saying this is the bottom, but this is that sort of seminal event, the Silicon Valley day, that is closer to the bottom than the top.
After 2008, the big banks had to go through vigorous policies. They have to be stress tested, and they stress test these big banks to make sure that they could withstand large economic shocks. Well, we've gone from 0% for 12 years, 0% interest rates for 12 years, and then spiked it up to 5%. So this is a shock. And what we're seeing is the smaller banks going under, like Silicon Valley, Signature, Silvergate. These banks are going to continue to fail. And will it add up so the bigger banks fail? Because if it does, the Fed's got no choice but to bail everyone out again. They'll use Signature and Silvergate Bank as ammunition, as a catalyst to say that we need to regulate crypto or else this would have never happened. Signature and Silvergate were the banks that started this chain reaction, and crypto assets were at its core.
In the UK in 2020, the Digital Regulation Forum, the Cooperation Forum, was established to ensure greater cooperation across government on digital matters. Imagine if we empowered the Privacy Commissioner's Office, the CRTC, OSFI, FinTrack, and the Competition Bureau to work in tandem. I'm pleased that this government has committed to overhauling our privacy and competition law, but we've got to go further. It's important that the privacy laws get overhauled because they're outdated. The biggest cybersecurity risk that most Canadians face today is simply pressing I accept. We have little or no control over how our data is used, and we have no data portability rights. No wonder our biggest private companies often think that our data is theirs to do with what they wish. Take competition law reform. Our Competition Act has caused consolidation in every sector, creating an oligopolistic economy. Too often, our massive incumbents control the policy agenda.
Policymakers all around the globe are focusing on individuals' privacy. Big tech has created their entire business model around spying on the users. Web3's promise is to allow individuals to control their own digital footprint. The XX network is focusing on the utility of privacy. It's blockchain agnostic. Any CBDC or distributed ledger can use CMIX. CMIX allows a layer of privacy. If regulators pass privacy laws, it's going to disrupt the entire business model of the internet. XX is open source and any chain can plug into its MIX network. Instead of developers building their own MIX network, They can expand on what XX has already built.
Well, of course, this whole thing is a concerning point to me, for sure. But my whole point is the big six banks are the biggest ones, right? And they actually are overcapitalized right now. They have had years and years and years of regulators on top of them making sure that they raise enough capital. And by the way, the 22 other banks, largest banks in the country, had to do the same thing. So the capital levels are better. And I do think that Silicon Valley was one of the most risky. I don't want to even talk about the crypto-exposed banks. I just don't, because they don't even mean anything. They're so small. But I think that Silicon Valley Bank was of the bigger names, of the bigger companies, they were the one that really were much more exposed. It's not that I'm not troubled by it. I just don't think it's a contagion at this point in time, because again, you have these other banks, the biggest banks in the world that are so overcapitalized. I don't think this is a great financial crisis kind of a situation. I want to say this is a one or two off kind of thing. Does that mean the banks are going to be good investments for the near term? Probably not, because everyone is going to be nervous. But I'll bet you anything, when the companies report earnings, people will feel better about the underlying situation. By the way, the big six, they have very little mortgage exposure too. That's also something that they have changed over the last many, many years.
Silicon Valley Bank has $20 billion in debt. Now, they're a bank with fractional reserve lending. This $20 billion very well could be $200 billion. But who do they owe that money to? The debt is somebody else's assets. Imagine you have a bond that's worth $100 in 10 years from now, but today it's trading for $50. The banks have to write down that they have $50 and not $100, and this is causing big gaps in their balance sheet. First Republic, Signature, Silvergate, as well as Silicon Valley Bank. These are all smaller banks, and that's what the talking heads on CNBC are saying. These are smaller and you don't need to worry about them. But Charles Schwab is down 20%. Some of these bigger banks are showing weakness. February 28th, I tweeted, "I've seen a lot of bullish commentary. I don't think the bottom is in. The debt market is flashing red. This ends with a crisis." I posted this February 28th. You could see Anthony Welfare. He liked the tweet. Now, what's interesting is Anthony Welfare, he's the CBDC lead. So he's the CBDC advisor for Ripple. 4 hours ago, he tweets, "Feels like the markets are about to explode. This was my walk home. Wave, wave." So obviously, if he likes my tweet that says I've seen a lot of bullish commentary, I don't think the bottom is in. The debt market is flashing red. This ends with a crisis. He's obviously bearish, yet he sends out a tweet that says feels like the markets are about to explode with waves crashing and fireworks. So you tell me what you think that means.
Canada leads the OECD in regulatory burden, particularly in the form of command and control regulations. These define the required process, not just the intended outcome. Consequently, the opportunity for made-in-Canada competitors to create globally scalable efficiencies is limited. As innovation and productivity growth accelerates elsewhere in the world, we need to get serious at home. The required work is like plumbing. It's economic plumbing. It's boring. It doesn't result in an announceable for politicians. And no one seems to care about plumbing. That is, until the toilets start backing up. Then we panic. What you are speaking about here today is economic plumbing. It is hugely important. It is foundational. It is central to the prosperity of our grandchildren. Please help us all make an even more compelling case for its prioritization. I will be listening intently, and thank you sincerely for the opportunity to be here and for your collective efforts on our collective behalf.
Canada is opening their banking rails. The economic plumbing is being redesigned. Smaller companies, crypto companies, will be able to offer their products. Simultaneously, the macro environment is freezing and de-risking. If the traditional system freezes, the only rails that will be open are through distributed ledgers. Never let a good crisis go to waste. Part of the reason FTX collapsed is because they took the FTT token. There was very little that were actually trading, and they levered their FTT token. So they owned the majority of FTT tokens, and they only let a few tokens trade. And that gave it a really high price, and then they had a ton of tokens on their balance sheet, which then they levered. So when this dropped, their collateral went to nothing, and they built a whole house of cards based off of it. Well, this structure, the same exact chart structure, looks very similar to what's happening with BNB, right? We had this massive upswing, and then we had these two peaks, came down, and now you're kind of rounding right there, right? So you had the two peaks, you had this upswing, and now this came rounding up and then crashed. So what will happen if BNB's price plummets? Has Binance set up the same type of system as FTX? We don't know, but if the BNB token takes a fairly large hit, we'll find out. Today, HTU, which is Yabwe's token, Yabwe, if you're unfamiliar with the exchange, is a fairly large Asian exchange. It's probably one of the biggest crypto exchanges. And look what happened. Out of nowhere, you had this 70% drop, and then all of a sudden it got bid right back up. So if the exchange, I don't know for certain that the exchange is doing this, but if they were, and a whale sold or something, and then they pushed the price back up because they may have levered their collateral like FTX. If society fits you comfortably enough, you call it freedom. Thanks everyone, I hope you enjoyed the show. Please take a moment to like and subscribe. If you enjoy content like this, please consider joining my Patreon or my website, dmjr.ghost.io.